All traders do homework, but at high school, I hated doing homework. But as a trader, I get paid to do it. Hi everyone, my name's Tim Fairweather from Zen Trading Tech, and in this video, I'm going to show you another simple daily practice drill that you can use to become a better trader. In this video, I'm going to talk about why we need to do our homework as a day trader and how it can lead to us taking higher probability setups on the following day. In this video, I'm going to show 5 examples which could have helped you get a really profitable swing or in fact the trade of the day simply by doing your homework every day. Okay, so let's talk about the power of homework. I'm just on the Zen Trading Tech blog. So this first example is the major trend reversal. This is the low of the day and a trend line break. You can see on this bar here, this is a good looking bull signal bar, but it follows after 1, 2, 3, 4, 5, 6 bear bars in a row. This is a strong bear breakout. It's also getting to a new low of the day. It's possible that traders are looking at this as a test and a move down. Other traders are looking for the trend line break and a move up. This is a swing entry. So if you're going to take this entry, you have to hold it for a couple of legs. The first buy is a test of the moving average. Better to be selling and selling higher. Once you've got this entry, good signal bar, good entry bar, good follow through, traders were able to move their stop up every time they got a new high, and that's where the swing trade ends. The following day, strong bear spike. We break a trend line. I bought this bar here and got out above the high. That was a 20-point target. But I was more interested in how this sell was going to go down here. Because I did my homework the day before, I wasn't expecting this to keep going. I thought that was already a day's range, and there was a chance the bulls were going to get a good reversal. Good looking reversal bar, small bit of follow through, bull inside bar. I think a lot of traders started to buy on the way up here, expecting for 2 legs up. Other traders waited for this strong spike and then started to buy below and above for 2 legs. Homework one day, homework the next day. If you did your homework on this day, you would have been ready for this open here. Here we've got a gap up, overlapping bars, 1, 2, 3. Here we've got a gap down, 1, 2, 3. I was long under yesterday's low here, looking to add on for a test up to the highs. I was not able to get long here. The market moved too quickly, so I had to buy on a pullback to get long for a move up. So to me, these are the same kinds of open. Here is the 200 moving average, and that means I'm looking to find reasons to buy low and take profits at new highs. Homework here, paid off here. What about this day? This is a big gap down, and this is a small gap up. Why are they the same? Well, I think they're the same because this is very strongly always in long. This is the first pullback. Here is a buy signal. Here is follow through. Everyone knows that the stop goes down here. You never got stopped out. That was the low of the day. When you come into this session, here is a bull breakout. We did not run the stop down here. Now we've got one buy signal. Now we've got a second buy signal. This buy signal triggers and gets follow through and follow through. This day has a breakout pullback long. This day has a breakout pullback long. You knew you took a good trade because you instantly got great follow through. So you're expecting a couple of legs up. Even though this had a deep pullback, it never ran that stop. Homework on this day, you're ready for this day. The other way you can look at these days is say, well, this is incredibly strong. This is incredibly strong. This is a bull bar. I'm expecting the next day to probably hug this trend line. And you can see that's what we did. We came down to it and we shot back up. So you're looking for evidence of this kind of channel to participate the next day as well. The ability to trade a channel is a real enabler at getting green more often and enjoying trading. It's going to minimize the amount of scale in losses you take, and you're going to be able to sit in that trade for more legs. Come on, Tim, as if these 2 days are the same. They're both gaps up. This has a second entry short. That's 1, that's 2. We never ran the stop. Inside bar, they're actually 2 big sell signals. We went below this bar, then we went below that bar. If you were fast enough to sell during that bar, that's fine. If you're not, you're waiting for a breakout and a pullback, sell. Breakout, pullback, sell. Breakout, pullback, sell. Breakout, pullback, sell. Second entry short, breakout, pullback, sell. Never triggers, never triggers, never triggers. Your stop never got run. These 2 days were also similar because if you look at yesterday's high and yesterday's high, Traders were selling above it. Bulls didn't want to buy above the high on the daily chart. They wanted to buy pullbacks. So there's a good chance the same thing's going to happen the following day. Here is a gap up. Here is a gap up. You'll notice that most bull bars on the daily chart don't look like this. They have a small tail below them. So if you imagine on the day, you have a small move down, and then this just works higher. And this is the open. Here is the open. This is the pattern on the daily chart you want to pay attention to. Gap up and consecutive bear bars. So some traders are looking to sell. I can't take a buy, yet I need more information. That's one buy signal. That's two buy signals. Neither of them get stopped out. That's a third buy signal. Now we're talking. None of these earlier bulls have gotten stopped out. You're better off having a run for a measured move up than trying to fade this move. What about over here? Gap up, big bear bar, triggers. Big bull bar doesn't trigger. Another bear bar doesn't trigger. We're creeping back to the moving average. Bears want to close that gap. Bears could have sold under there, but this bear bar didn't trigger either. 1, 2, 3. This is now the third decent buy signal. And if you draw a line, even if you didn't take it immediately, that was the line in the sand for a swing up. The other way to look at it is here is an opening range. Here is a breakout. Here is an opening range. Here is a breakout. So another way you could trade this is to say, I don't think this is enough for a whole day's range. We're either going up or we're going down, but we're above both moving averages. Here, we're either going up or we're going down, but we're above both moving averages. So I'll always give that extra 5% to the bulls if they can do this. And the reality was it wasn't very strong, but it just kept working high. Well, thanks very much for watching. I hope you found that valuable. In this video, we talked about why we need to do trading homework and why we get paid to do it. My name's Tim Fairweather from Zen Trading Tech. Thanks very much for watching, and I'll catch you in the next video.